Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're keeping very, very well and that you've had a fantastic week. It's been quite busy actually for me. Friday and Saturday I was at the Property Investment Show in Excel in London, and it was really, really nice to get out and have a chat with lots and lots of landlords and investors and really to kind of see what people are up to and how they're feeling about things at the moment. So I think what I'll do is probably towards the end of this video, I'll just do a little bit of a kind of update of the kind of stuff that we were hearing about. I think it's always very nice. As a landlord, it's quite an isolated job, and so it's always quite interesting to hear what our peers are up to. But in addition to that, this week we've got our usual update in terms of lender pricing changes, lender criteria changes, and also we're going to be covering off our newest feature, question of the week, as well. Okay, so let's kick things off with interest rates, both swaps and also lender pricing. And I think it's fair to say that the rate of very, very rapid change that we've been seeing over the last few months, it seems to have quietened right down in the last couple of weeks, which honestly is a very, very good thing. With sort of slowness of change and consistency comes confidence. So when lenders are not seeing pricing bouncing around all over the place, it means they're kind of able to take a more kind of stronger view and be able to drop rates down. So actually not a lot of change is a very, very good thing, particularly at the moment. So in terms of swap rates, 5-year swap rates today, so Tuesday at around 2 o'clock in the afternoon, 4.541. 1 month ago they're at 4.694, so down a bit, but not hugely. 2-year fixed rates, 5.045, were 1 month ago 5.301. So again, things have stepped down over the month in terms of swap rates in the right direction, but nothing really kind of hugely life-changing either, which honestly, guys, is a really good thing, I promise you. Now, in terms of how the continued downward pricing on swaps is impacting the mortgage market, so again, we've seen lenders repricing. It's been much quieter than we've seen in previous weeks, excluding the kind of final 2 weeks of summer holidays where, essentially it felt like nobody was working at all. So you've seen the Mortgage Works reduce pricing by up to 0.15%. We've seen Accord drop their pricing down by up to 0.5%. We've seen downward pricing from the West One, Skipton, Fleet have dropped their rates by 0.2%, and also the Coventry. Now, interestingly, we have seen a couple of lenders increase their pricing. So MT Finance and the Cumberland have both increased their rates in the last week. The Cumberland, I suspect, is probably down to business volumes. The Cumberland are a very specialist lender. They are incredibly good at holiday lets. They underwrite holiday lets in the truest sense of the word on the holiday let income, rather than using a notional AST rental income. They can do limited companies. They can do quirky properties. So, for example, multi-units as a holiday lets. They do some really, really good stuff. So they can get quite overrun with business quite quickly because they are a very small institution. So I'm sure their increase in pricing is largely down to that. I think MT Finance is probably, they did quite a significant rate drop a couple of weeks ago. Actually last week swap rates did bubble up a little bit and they've sort of eased back down again, but it could be that their pricing just increased the point last week where they realised they had to kind of change things back slightly just to kind of make sure that the numbers still made sense. So I don't think there's anything too much to read in those two changes. Now, in terms of how this is all kind of shaking out into the market, so at the moment, if you're an individual and you're looking for a 2-year fixed rate on a straightforward property, pricing from 2-year fixed is from 4.59% with a 5% fee, or 5.24% with a £4,000 flat fee. If you're an individual and you're looking at 5-year fixed rates, 5-year rates are from 4.69 with a 7% fee, or 4.79 with a £4,000 flat fee. Same thing for limited companies now, so 2-year fixed rates from 4.69 with a 5% fee, or 5.69 with a 3% fee, and 5-year fixed rates from 4.19 with a 7% fee, or 5.55 with a 3% fee. And I think it's just worth, if we just take that last range of data just by comparison, so 4.19% with a 7% fee, most people, their immediate reaction is, I'm not paying a 7% arrangement fee, there's no way. But actually what you need to do is apply some very sort of simple maths to this. So 7% arrangement fee spread over 5 years is essentially 1.4% per year. Add that onto the 4.19 interest rate, so you're essentially paying 5.59% as the actual interest rate. Now, if we compare that to the second deal that I gave you, which is 5.55 with a 3% fee, so 3% split over 5 years is 0.6%. So 5.55 plus 0.6% is 6.15%. So you will see that actually the 4.19 with the large arrangement fee, while the fee does feel slightly shocking, actually, if you just apply maths to the numbers, that is actually still the superior deal. And that is why at the moment we're seeing lots and lots of clients actually favouring these higher arrangement fee products, because in the round they are the better rate. And I think these rates are very much here to stay for the time being. So originally the lenders introduced these types of products to drive down the interest rate, to essentially afford a more lenient rental calculations. That's why people tend to have these products in their product set. So lower interest rate, particularly on 5-year fixed rates, generally means a more generous rental calculation, which can be a real godsend at the moment for landlords when they're trying to borrow a certain amount of money, and on those rates with higher interest rates and lower fees, the numbers don't work. So actually they're very, very good. But actually, the second benefit to these is they can also be incredibly competitive as well. So as always, if you want to have a look at some options and you just like us to run through the various deals available to you, but also do this kind of maths on your behalf, we'd be delighted to help you with that. Okay, now the Kensington have made quite a significant number of changes actually to their lending policy in the last week. And reading through these changes, actually some of them are really interesting and forge essentially a good kind of discussion point for our video more broadly. So the first thing they've done is they're now accepting deposits via intercompany loans for limited company buy-to-lets. So what this refers to is when you've got a limited company that's purchasing a property, the deposit may just come from you as a director, in which case you just lend it to the company via director's loan structure. But often what we find is that people will have a limited company, which is like their day business essentially, which has amassed a series of cash in it. And the investors want to be able to use that money to buy another buy-to-let, buy a buy-to-let property. But what they don't necessarily want to do is acquire that property in the existing limited company, their trading company, because you don't really want to muddy the waters. One's my day job and one's my property investment. You don't necessarily want the two all sitting in the same place as each other. So people often favour the option to have a new SPV set up for their acquisition. So the question becomes, how do I pull money from my trading company and get it into my new SPV? So what you can do is you could essentially pull the money out from the business into your own name, but that would then incur some tax. So dividend tax, maybe you class it as a director's loan repayment, which is not taxable, by the way. But there's various ways of putting the money out. But actually what people prefer to do is lend it from one company, from the trading co, to the new company via what's called an intercompany loan. Now, a lot of lenders don't actually like intercompany loans. So if you find yourself in a situation, so you've got a trading company with money and you're going to use that money to buy a new buy-to-let, you do need to just really have that conversation with your broker in terms of, well, how is the money coming from company A to company B? And as long as the broker knows which way it is, whether it's an intercompany loan, whether you've got a layered company structure so that it's a group of companies and the money's simply passing down, we just need to be aware of it, because like I say, not every lender accepts this, so it's important just doing your research on this to make sure things fit. Now the next thing they have said is there's no maximum age for clients on buy-to-let applications, and we've covered this off actually I think on Question of the Week a couple of weeks ago in terms of ages. So buy-to-let I think is more lenient on ages than homeowner mortgages, and rightly so. But broadly speaking, if you are applying for a mortgage before your 70th birthday, there's going to be lots and lots of lenders who can lend. So for an example, the mortgage works as long as you haven't hit your 70th birthday at the point of application, you could have a 30-year term. Precise mortgages, you can be no more than the age of 85 when you apply for a mortgage, and you can then have a 35-year term. So it's really interesting to see that Kensington are now joining this party, and rather than putting kind of what I would actually say is a fairly arbitrary maximum age on the mortgages of say 75 years old, they're actually just saying that we don't have a maximum age, full stop. Now another great thing they're doing is they're saying that mortgage offers are now going to be valid for 180 days from the date of valuation. Now the reason this is really important is this kind of comes into play in terms of those people who are being particularly strategic in terms of looking at their remortgages. So mortgage offers are generally valid for either 3 months or 6 months, depending on the lender. Now, for those of you who, particularly after the last year, I mean, dear God, we all kind of want to be able to plan things and know where we're going to be standing. So if you've got a mortgage ending in, say, 6 months' time, and you approach the lender who has a mortgage offer valid for 3 months, invariably what would happen is your mortgage offer would come through in circa 4 weeks. It's valid for 3 months, but you can't complete for a further 2 months. The offer would have to lapse and you'd have to start all over again. So actually making sure that you're applying for a lender who has a offer validity period that kind of fits within your requirements is really, really important. And this particularly comes into its own for those people who are recognising that interest rates have come down, they're not as high as they were a few months ago, thank goodness, but also are worried about the fragility, and it is fragile at the moment, the market and where things are going to go. So if you've got a mortgage ending in sort of like May next year, you could apply for a mortgage now, book a rate. Obviously, if interest rates increase during that time, your rate is booked until May. You've got 6 months because it's this lender who gives a 6-month offer. But likewise, if lenders' rates or your lender's rate comes down between application and completion, there's a very strong chance we would be able to move that onto the cheaper deal. So essentially, it's like, well, some would say hedging your position, others would say having your cake and eating it, and who wouldn't want to do that, right? So just worth knowing that Kensington have joined the 6-month mortgage offer club. Other things they've done, so they're now able to accept clients with pre-settled status, as long as it's within the Gov UK share code. They've removed their maximum 10-year term for interest-only cases. And finally, they've also dropped the minimum age down to 18 years. So on on normal buy-to applications, we can have one borrower who's 18 as long as there is a 21-plus-year-old joining them as well. So lots of buy-to-let lenders don't want to lend where someone's under the age of 21, but actually the Kensington can as long as there is another applicant who is over that age as well. Okay, and moving on to question of the week. Thank you, Andrew, very much for sending that in. I hope you're keeping well. We haven't spoken for a while, so I hope life is very good for you. Thank you very much for your questions. The question was, I have a buy-to-let which has a short lease. Are there any mortgage companies that would be able to remortgage the property as well as be able to add the lease premium to the mortgage? So what Andrew's essentially saying here is that would I be able to remortgage and include the cost of increasing my lease within the remortgage proceeds? Which is actually a very, very common way that people would raise money to be able to fund the cost of a lease extension. And lease extensions can be as little as sort of a few £1,000s, and they really can be up in the hundreds of thousands of pounds. It really depends on the value of the asset and also how long is left at the lease, at the point of lease extension. So to answer Andrew's question, yes, you can absolutely factor in the cost of the lease extension as long as the lease will be extended by completion. Now, this would be, I guess, particularly relevant for those properties with very short leases. And in the mortgage world, I'd say anything less than 70 years starts to cause you a bit of a problem. Now, if you had a lease, for example, that was 80 years and you wanted to refinance to, raise the money to cover the cost of that lease extension, actually the two wouldn't need to go hand in hand, because when the lender releases the money to pay for the lease extension, they've already got a relatively long lease on the property. But if the lease is quite short, then yes, absolutely, you can still do this, but the key thing is the lease extension would have to happen contemporaneously, is the legal terminology here, at the point of the mortgage going through. So when the lender's mortgage completes, the remortgage goes through, actually they've lent on a property with a longer lease. But normally the solicitors wouldn't expect to get paid on the lease extension until it kind of clicks in, so that should tie in quite nicely. I hope that explains it. I'm not sure I've done the best job of giving you that answer, but hopefully it made sense. In terms of short leases, incidentally, while on the subject, it's a very good subject to raise. Like I say, generally speaking, leases are only considered short, in the mortgage world at sort of circa 70 years or below. There are some lenders who have slightly more onerous requirements than that. There are also lenders who are like, look, as long as it's more than 55 years at the point of application and no less than 40 years, and at the end of the mortgage term, we can work with that. So there is a kind of lot of flexibility. Obviously, once the lease goes down below a certain point, the property starts to devalue, so you will also need to keep that in mind as well. And that is question of the week. And really just to kind of reiterate what I've said in the last few weeks, please do keep questions coming in. It really is actually lovely to be able to answer questions that you guys are interested in. This video is obviously for you. So the more we can find to talk about that is really relevant to you and the things that are in your mind, the better it's going to be. So if you wouldn't mind just commenting in the box below this video, if you do have any questions, I'd be very happy to answer them next time around. Now, just lastly, a quick reflection really on the kind of sentiment and vibes we were getting from the landlords at the Property Investor Show. Now, I suppose I should caveat this with, if you're at a Property Investor Show, there is a chance you're actually looking to invest in property. So you may find that the people who are there are kind of more pro-investment than is representative of the whole landlord community. But what we found is that actually, speaking to landlords, the general consensus is that you know, it's not been a great year for people. Higher mortgage costs, renters reform bill, all this back and forth with the EPCs and the MEES requirements, you know, and lots of stuff going and lots of noise. But actually what people were saying is that we've kind of become accustomed to hearing about these higher interest rates. Yes, when I come off my very good deal of 2.5% and I'm going to go on something at 5%, it's going to feel really, really uncomfortable. But we always knew those very low interest rates weren't here forever. It was just a kind of moment in time. But actually, what really impressed me, and landlords do always impress me because you really are the most resilient bunch of people I think there are. A lot of people are actually like really going back to their portfolios and reconsidering how they can utilise their assets to make a stronger return. So with higher mortgage payments, you know, looming for people, they're kind of thinking, well, how can I sweat my asset to ensure I'm getting the most, the highest level of return that I possibly can. So definitely people are reconsidering HMOs. As we know, HMOs are more high yielding than standard properties. So there are landlords who are looking to kind of move some of their properties onto room by room letting. Other people are definitely going back towards more like Airbnb type lending and also serviced accommodation. I spoke to a couple of landlords who are thinking about letting their properties out to housing providers such as Serco. They really like, because of this, the idea of being able to hand the property over on a 5-year lease. It's fully repairing and insuring. So in 5 years' time, the property just is given back to you in the same condition that you gave it across in the first place, but likewise guaranteed rent as well. But I think the overarching kind of sense was that people are really looking to try and see if they can maximise return on their properties at the moment. The other thing I would say is that actually definitely more landlords are now starting to think about buying again. And I think this is really kind of linked to lower property prices, higher rental yields, and rental yields are still increasing. We'll probably have some rental data for you in the next couple of weeks actually, but the reports are still very much that things are continuing to increase. And yes, the mortgage costs are a bit higher, but actually if you can buy a property now for sort of £30,000-40,000 less than you would have paid for it a year ago, but the yield has increased. Yes, the mortgage costs are higher, but the two kind of can work out quite nicely for some investments. So definitely landlords looking to come out and invest again as well at the moment. So I think overall, generally speaking, quite positive. There were a couple of people who were feeling a bit kind of naffed off, shall we say, and are thinking about selling 1 or 2 properties, but I didn't come across a single landlord who's thinking about exiting the market altogether. It's more about rejigging their portfolios to try and make sure, like I said, that they're getting the best cash flow they possibly can. And that's us for this week. So as always, thank you so much for joining us. I hope you find it helpful, and I shall look forward to seeing you again in a week's time with more wonderful mortgage news. Until then, look after yourselves, and as always, if you have any questions, just give us a call, 0345 345 6788. I hear the weather is about to turn. Be time to get your woolies back out and start getting ready for Christmas, I reckon. I think it's going to be raining this time next week, so I probably won't be quite as chipper, but until then, keep warm and dry.